In this video, I'll be running through how to fix 30-day sell-through rate in high-SKU DTC brands. If you've watched our consulting framework video on the 6 bottlenecks to e-commerce growth, you'll know that 30-day sell-through rate is one of the big bottlenecks that restricts the cash conversion cycle and therefore leads brands into a position where they have overstock in inventory. They're not turning over inventory fast enough, which completely restricts their ability to reinvest free cash flow into scaling up marketing and new customer acquisition. This video will be through the lens of an actual case study. This is an actual brand that we work with. This is an actual situation that they were in, and this is how we fixed it. This is on the very, very small end of brands that we work with. So their annualized revenue sits at $800,000, and their inventory value was sitting at $400,000. And we came to realize this when we tried to scale up their marketing spend, but they had no available free cash flow to do so. So we took a look under the hood a little bit deeper. We found their lead time plus safety margin was 45 days from their manufacturers, which means that their overstock value was $301,000. They were overstocked in what's almost half a year of revenue. All their capital was stuck in inventory, but why? Well, firstly, let's take a quick look at the brand economics so you know what lens we're looking through. The average order value is 150, MMU's 2, CAC's 21, CRR's 35%, 20% 30-day sell-through rate, and their OPEX was $19,000. And you can see we modeled their cash cycle over a 60-day period on the right there. You can see that they're making money month on month. They're making about $3.5 thousand. Now, there are some optimizations within OPEX that they should have done as well, and they have done now, which has made this number even better. But they were losing about $4,000 into inventory. They were kept overbuying and just turning their free cash flow straight into inventory, as you can see up the top here. There were 3 primary operational issues that led to this position. Number 1 is MOQs for top selling SKUs were really high. So every time they were ordering way more than they needed, and they were overstocked for 300 days. Number 2 is they have $300,000 in inventory that just simply isn't moving. And number 3, their MMUs, their maintained markup on about 60% of their SKUs was only a 1.5. Why this is such a big deal is that if you don't have a large markup on your products, you end up needing to hold a lot of your cash in inventory due to the lack of markup, right? If they had a 2x markup here, then the amount of stock that they would need to hold would be half relative to revenue. So maintain markup and margins actually becomes really important in how much capital you need to hold within inventory. How did these 3 situations even arise? Well, number 1 was because they really never went to the table for negotiations with suppliers, never looked at negotiating MOQs down. Number 2 is they thought they had this assumption that to become a leader within their particular niche, they needed to add more and more and more and more products and more SKUs to become almost a marketplace within that specific domain. And that's what would grow the business. And that's what would increase revenue. Most brands have this assumption, and it's a complete flaw. Yes, to grow revenue at a certain stage, you do need product launches. That is a fact. One product will only generally take you so far, particularly within a very specific domain, particularly within a specific domain within Australia. However, layering on 100, 200, 300 new SKUs for the sake of growth does not work. And you need to be very, very calculated in what products you launch based on your existing high demand customer database. And so they should have been looking at their existing customers, surveying them and going, what products do you want to see from us? And then launching accordingly, not blindly adding SKUs based on what the manufacturers were suggesting. So this essentially just occurred because of 1, a flawed model that adding more products would equal growth. And number 2, manufacturers tricking them into buying more and more products. And number 3, maintain markup. This is just incorrect pricing. Okay, and we're going to have a video on this in itself, which is how to price. But most brands do not price correctly. They just keystone price, which is our COGS is this, double the price, or our COGS is this, 1.5x the price, or competitors are selling at this, so that's what we should sell at. But it's not the correct way to price products if you're trying to operate a profitable business. So what we focused on was increasing 30-day sell-through rate. That was the specific focus here. So how do we do it? Number 1, identifying overstock. So we pulled all of the product data as well as stock on hand into an Excel sheet, as you can see here, which allowed us to identify overstock within particular products, as well as days of overstock. We also had MOQ in here so that we could relate accordingly. Which then leads into number 2, which is that we broke down the existing customer database into quantiles so that we could curate discount offers accordingly to move a lot of the overstock. And so we looked at breaking 2022 customers down into quantiles based on spend thresholds, and then measuring how these customers pathwayed over into 2023 to identify whether customers were declining, retaining, lifting, or defecting. What we then looked at was curating and exporting this customer data to have individual targeted offers based on the individual customer profile. And so for lifted and retained customers, we were curating offers there, but with loyalty-based messaging. So the emails that were going out or the ads that we were running to custom audiences was, thanks for being a loyal customer over the last 2 years. Here's an offer specifically for you. And so that's how we were moving stock to those customers within the database. And then we were going quite hard on the defective market as well, to identify what products did they purchase that they didn't then come back and repeat buy, and could we discount the overstocked products to them and push them in essentially win back email campaigns. Number 3 is we analyzed profit contribution at a product level by segmenting the entire SKU range into deciles. So similar to what we did with quantile breakdown at a customer level, we apply very similar logic, but at a product level. And so that allows us to break down products into deciles and then identify profit contribution at a decile level as a proportion of total profit contribution of the store. And what you'll see here, I've blurred out a lot of the numbers, but on decile 1 and 2, decile 1 drives 62% of profit contribution. Decile 2 drives 17%. Decile 10 and 9 drive 0.1 and 0.3%. So almost nothing. These products are doing nothing. They're just sitting around as stock and they're driving no incremental profit to the business. And so they either need to be cut or they need to be sent out in emails, offerings to turn them over. And so this is what then leads into a deep analysis process, which is, are low sell-through rate products or low profit contribution products due to inefficient marketing or poor market demand? And that's a really important question to know the answer to, because we can make an assumption and just say, oh yeah, these products aren't selling because there's no demand for them. But that's a flawed answer, right? We might just not be marketing these 241 products that well. Okay, we might not be pushing them effectively in our Google shopping campaigns. They might be spending nothing. We might not be pushing them on Facebook. They might not have a high degree of discoverability within the navigation of the website. So how are people even going to pathway to these products? Are they being pushed within emails? There's all these questions, right? These might just actually just be neglected products. They might not be bad products. So we need to identify, is it inefficient marketing or is it poor market demand? Here's what we found. About 100 products had poor unit economics. So outside of inefficient marketing and poor market demand, we just shouldn't even be selling these products. Okay, if a product has 15%, 20% gross margin, let's not sell it, because we really can't acquire customers profitably if you only have 15 to 20% gross margin on these products with the repeat purchase rate that this brand has. So let's cut them completely. Let's discount them to cost price, get rid of them, cut them out, or let's reprice them. Let's price them correctly. We found that 20 had really poor MOQs. Even with negotiations with suppliers, the MOQs were so high that you're having to buy 200 to 300 days of overstock. And it just does not make sense to finance 200 to 300 days of overstock, even if they're driving profit contribution, because you have to raise that capital from somewhere. And depending on how you want to calculate the cost of capital, whether you're actually taking loans to fill these inventory buys, or whether you're using your own cash on hand, it's enormously expensive to have 300 days in overstock, even if the products are profitable. You do the math, it often ends up to net zero or net negative. So we said, let's cut them as well. Let's move them, let's cut them out unless we can get better MOQs from suppliers. And then another 30 we found probably just had poor market demand. Okay, they were either incredibly competitive products where on Google Shopping, everyone was undercutting us, and I don't know how, like what margins are the competitors operating at if we're operating at 20 to 30% on these products. And so we identified that we just have to cut these products completely, cut down the SKUs. This is what ended up happening. Firstly, MMU went up to 2.6. Average maintained markup across the selling portfolio of products increased by almost 50%. That makes an enormous difference to the amount of inventory that you have to hold on hand as a proportion to top line revenue. And number 2, we're now just driving more contribution profit to the bottom line without any change in CAC. And then on 30-day sell-through rate, we improved from 20% to 31%. From everything that we just went through, in addition to tightening up inventory buys. So we no longer had high MOQs. We no longer had a bunch of inventory that wasn't moving because we moved it through looking at quantile database breakdowns and sending offers accordingly with the products that weren't moving, and then cutting them out of any new inventory buys. And then number 3, we improved the MMU through better pricing, as well as just cutting all of the products that had poor unit economics.